Hello, everyone, and welcome back to Financial Market Insights for Traders. I'm your host, Sophia. Today, we're diving into one of the most important topics for investors, traders, and anyone following the global economy, our mid-year macro review 2026. Specifically, we're going to explore what has changed since the start of the year, what surprised markets, what trends have emerged, and what investors should be watching as we move through the second half of 2026. At the beginning of this year, there was a fairly clear consensus among economists, analysts, and market participants. Inflation was expected to continue falling. Central banks were expected to begin cutting interest rates more aggressively. Economic growth was expected to slow but remain positive. And many investors believe that 2026 would be a year characterized by greater stability compared to the volatility experienced over the previous few years. 6 months later, the picture looks considerably more complex. The mid-year macro outlook 2026 has evolved significantly, and for traders and investors alike, reassessing the macro landscape has become essential. Many of the assumptions that shaped market expectations in January have been challenged by actual economic data. As always, markets have reminded us that forecasting is difficult and that economic reality often unfolds differently than consensus expectations. Let's begin with economic growth. One of the biggest surprises of 2026 so far has been the resilience of economic activity across many major economies. At the start of the year, many economists expected consumer spending to weaken under the pressure of higher borrowing costs. Businesses were expected to become more cautious with investment spending. Labor markets were forecast to soften as the effects of restrictive monetary policy filtered through the economy. Instead, much of the developed world demonstrated stronger than expected economic performance. Consumers continued spending. Employment markets remained relatively healthy. Wage growth stayed supportive. Corporate investment activity remained surprisingly robust, especially in sectors tied to technology, automation, and artificial intelligence. This resilience has forced investors to rethink some of the recession concerns that dominated discussions entering 2026. While economic risks certainly remain, the first half of the year has demonstrated that higher interest rates do not automatically lead to immediate economic contraction. Households and businesses have generally proven more adaptable than many forecasters anticipated. This has become one of the defining themes in the mid-year macro outlook 2026. Now, let's turn our attention to inflation, which remains arguably the most important variable influencing financial markets. Inflation has certainly moved lower compared to the peaks experienced during previous years. However, the journey back towards central bank targets has not been smooth. Many investors entered the year believing inflation would continue declining at a steady pace. Instead, progress has been uneven. Goods inflation has moderated significantly in many regions. Supply chains have improved. Shipping bottlenecks have largely normalized. Energy prices have become less disruptive than they were during previous periods of volatility. Yet underlying inflation pressures continue to persist. Services inflation remains elevated. Wage growth continues to support consumer spending, but also contributes to pricing pressures. Housing costs remain sticky in several major economies. Healthcare and labor-intensive industries continue to experience inflation rates above central bank comfort levels. What markets have learned during the first half of 2026 is that reducing inflation from very high levels is one challenge. Reducing inflation from moderate levels back to target levels is often an entirely different challenge. For traders, this matters because inflation directly influences interest rate expectations, bond yields, equity valuations, currency performance, and overall market sentiment. As we continue reassessing the macro landscape, inflation remains the key variable to monitor. This naturally brings us to central banks. Perhaps one of the biggest shifts during the first half of the year has been the increasingly cautious stance adopted by policymakers. At the start of 2026, markets were pricing in multiple interest rate cuts from several major central banks. Investors expected policymakers to begin easing monetary policy as inflation cooled. However, stronger economic growth and persistent inflation have forced central banks to remain patient. Rather than committing to aggressive easing cycles, policymakers have repeatedly emphasized a data-dependent approach. The Federal Reserve, the European Central Bank, the Bank of England, and other major institutions have made it clear that they are willing to wait for additional evidence before making substantial policy changes. This has created a market environment where every economic report carries significant importance. Employment figures, inflation releases, wage growth statistics, consumer spending data, and business activity surveys are now capable of moving markets dramatically because investors are constantly recalibrating expectations regarding future interest rates. This heightened sensitivity to economic data has become a defining feature of the mid-year macro outlook 2026. Now let's discuss bond markets. Fixed income investors entered the year expecting lower yields and stronger bond performance. Initially, that narrative appeared reasonable. Declining inflation and expectations for monetary easing supported optimism within bond markets. However, as economic growth remained resilient and inflation proved stickier than expected, yields experienced significant volatility. Bond investors now find themselves balancing two competing narratives. On one side, inflation is generally moving lower over time, and central banks are expected to ease policy eventually. On the other side, economic activity remains sufficiently strong to justify keeping rates elevated for longer than initially anticipated. This ongoing tension has created uncertainty across fixed income markets. The bond market remains one of the clearest reflections of the broader macroeconomic debate currently taking place. Investors continue trying to determine whether growth or inflation will ultimately prove to be the dominant force during the second half of the year. Turning to equity markets, many investors would likely describe the first half of 2026 as surprisingly strong. Despite concerns surrounding inflation, interest rates, and geopolitical uncertainty, stock markets have demonstrated impressive resilience. Corporate earnings have generally exceeded expectations. Many companies have successfully adapted to higher borrowing costs and changing economic conditions. Profit margins have remained relatively healthy, particularly among firms benefiting from technological innovation. Artificial intelligence continues to attract significant investment capital and remains one of the most powerful themes driving market sentiment. Companies involved in AI infrastructure, cloud computing, semiconductor development, automation, and advanced data analytics have remained major areas of investor focus. However, strong performance also brings new questions. Valuations in some sectors have become increasingly elevated. Investors are now debating whether earnings growth can continue supporting current market levels. This is another important aspect of reassessing the macro landscape. Strong markets often generate optimism, but investors must continually evaluate whether expectations remain realistic. Speaking of artificial intelligence, it's worth discussing why AI has evolved beyond being simply a technology story. Increasingly, AI is becoming a macroeconomic story. Businesses across industries are investing heavily in automation and productivity enhancing technologies. Governments are developing regulatory frameworks. Investors are attempting to estimate the long-term impact of AI on labor markets, productivity growth, and economic output. Historically, major technological breakthroughs have transformed economies over decades rather than years. Many analysts believe artificial intelligence could represent a similar structural shift. If productivity gains materialize at scale, AI could influence economic growth rates, corporate profitability, labor market dynamics, and inflation trends for years to come. As a result, understanding AI is becoming increasingly important for anyone analyzing the broader macroeconomic environment. Another area that deserves attention is geopolitics. Geopolitical developments have returned to the forefront of investor concerns during 2026. Trade disputes, regional conflicts, supply chain vulnerabilities, energy security issues, and strategic competition between major economies continue influencing market behavior. Businesses are increasingly prioritizing supply chain resilience rather than simply pursuing the lowest possible costs. Investors are paying closer attention to geopolitical developments because they can rapidly alter market sentiment and create volatility across multiple asset classes. Whether examining energy markets, manufacturing sectors, transportation networks, or commodity supply chains, geopolitical considerations now play a larger role in investment decision-making than they did during much of the previous decade. Moving on to currency markets, Foreign exchange traders have experienced a particularly dynamic environment this year. Currencies have responded to differences in economic growth, inflation performance, and monetary policy expectations across regions. Economies demonstrating stronger growth and relatively higher interest rates have generally seen support for their currencies. Regions facing slower growth or greater uncertainty have experienced increased volatility. Currency movements are often overlooked by retail investors, but they provide valuable insights into investor confidence and relative economic strength. For multinational corporations, exchange rate fluctuations can significantly impact profitability and competitiveness. For traders, currency markets often serve as an important barometer of shifting macroeconomic conditions. Let's also discuss commodities. Commodity markets continue to provide valuable information about the health of the global economy. Energy prices remain sensitive to geopolitical developments and supply demand dynamics. Industrial metals provide insight into manufacturing activity and infrastructure spending. Agricultural commodities reflect both economic and environmental influences. Gold continues to serve as a closely watched indicator of inflation expectations, risk sentiment, and monetary policy outlooks. Commodity markets often respond quickly to changing economic conditions, making them particularly useful for investors attempting to identify emerging trends before they become obvious elsewhere. As we look ahead to the remainder of 2026, several themes deserve close attention. Investors should continue monitoring inflation trends and central bank policy decisions. Labor market conditions remain important. Corporate earnings will continue influencing equity valuations. Artificial intelligence investment trends deserve close observation. Geopolitical developments remain a significant source of uncertainty. Commodity market behavior will provide important signals regarding economic activity and inflation pressures. Collectively, these factors will shape market performance throughout the second half of the year. Before we wrap up today's episode, I want to share two valuable resources for listeners looking to deepen their market knowledge. For traders and investors seeking a world-class, cutting-edge, user-friendly trading platform, I encourage you to explore the Crystal Ball Markets trading platform at crystalballmarkets.com/platform. The platform provides powerful tools, market analysis capabilities, and professional-grade features designed to help traders navigate today's rapidly changing financial markets. If you're looking to enhance your trading experience and improve your decision-making process, it's definitely worth exploring. And if you're interested in expanding your knowledge of trading, investing, macroeconomics, and financial markets, be sure to check out the Crystal Ball Markets podcast at rss.com/podcast/crystalballmarkets. It's a beginner-friendly resource packed with practical insights, market discussions, and educational content that can help both new and experienced investors stay informed as market conditions evolve. To conclude, the first half of 2026 has reinforced a lesson that financial markets teach repeatedly. Expectations and reality rarely move in perfect alignment. The mid-year macro outlook 2026 reveals an economic environment characterized by resilient growth, persistent inflation challenges, cautious central banks, technological transformation, evolving geopolitical risks, and ongoing market adaptation. For investors and traders, reassessing the macro landscape is not a one-time exercise. It is an ongoing process that requires flexibility, discipline, and a willingness to adapt as new information emerges. The second half of 2026 promises to be just as fascinating as the first, and those who remain informed, objective, and focused on the bigger picture will be best positioned to navigate whatever comes next. Thank you for listening to Financial Market Insights for Traders. I'm Sophia, and I'll see you in the next episode.